and also a marketing executive of Phillip Futures. Thank you for your time joining us tonight. Hopefully everyone will get something tonight. Okay, so just a very quick introductions about our company in case there are some new people that just joined us for the first time. So our companies are, yeah, okay. Okay, so before I start, just a very quick disclaimer. So whatever that I share tonight is mainly for knowledge sharing purpose, and it doesn't really constitute any buy or sell call. Okay. Now, start off with our company. So our company, Phillip Capital, is our company, Phillip Futures. We are a wholly owned subsidiaries of Phillip Capital, which is based in Singapore. So our mother company, Phillip Capital, is based in Singapore, while our headquarters is based in Kuala Lumpur. So Phillip Futures, we are incorporated on October 1995. Okay, so have been in business for quite a long time. So our company, we are a trading and also a clearing participant of Bursa Malaysia Derivative Berhad. With this, we are also a holder of CMSL license. This makes us a legal broker house to operate in Malaysia, okay, and is regulated by the Security Commission to safeguard the interests of the investors. Sorry, my slides is a bit lagging. Okay, now this about our company. We are the first broking company in Malaysia that actually offer an online trading platform for both local and foreign products. Meaning to say, if you want to trade both local and foreign products, you do not need to log in into two different platforms to trade. Everything can be done under one roof, okay? Which is also one of the reasons why we are among the top choices for professional traders in Malaysia. Okay, so I would like to take this opportunity to say a very big thank you to all our clients. If you are our clients, okay, without you, we won't be able to achieve this. So in 2020, we have got 3 big awards from Bursa Malaysia. So we are the first runner-up as the best overall derivative participants, and also for retail derivative trading participant, and also for institutional derivative trading participants. Okay, so without you, we won't be able to achieve this. Now, our mother company, Phillip Capital, we actually have networks, or we have offices over the globe, okay, with different 14 over countries. We have offices in all these countries. So with this, we don't only offer products in Malaysia only. We also offer products listed under the Singapore Exchange, under the US Exchange, under Hong Kong Exchange, or the Tokyo or the Japan Exchange. Okay, we offer products from all over the world. Now, just like our company name, Phillip Futures, with our main focus all this while has been in futures trading, okay? And tonight we will be focusing on the agriculture futures, which is where David will share in depth about the grains, okay? So grains has been on really strong uptrend lately, and can the rally continue, which is something that David will share tonight, okay? So our focus has been on futures trading, but other than that, since last year, we offer a new product called the Contract for Difference. So in case you have no ideas what Contract for Difference is, you can contact us for more information. Basically, it allows our traders or our clients to trade the Nasdaq and New York Stock Exchange, and also Bursa stocks with a very, very attractive leverage. Okay, so you don't need a lot of money to trade the stocks. And we also allow our clients to short the US stocks. So if you think the market is turning bear, you can use this product to short the market, okay, to short the stocks. So why trade with our company? First of all, we offer 24-hour support for our clients. So no matter what is the time, even after the working hours, in the midnight, if you face any problem, you can call in to ask for help, okay? Someone will definitely be there to help you. And also, every day we will send out the latest market news or market updates exclusively for our clients. If you need help to know what kind of products that are suitable for you, or if you need one-to-one coaching, you can contact us, okay? We might be able to help you from the wide product range that we offer, okay? Now, for us, we offer one-to-one coaching section, like I said earlier. where if you are beginners, don't worry about it. We can guide you through what is futures, how to use our platform, or some basic technical analysis. Okay, and also we organize free webinars on a monthly basis, something like tonight. Okay, free for everyone to join. And also account opening is free of charge. If you want to open an account, we have online account opening. It's free of charge. We just need you to fund in a minimum of 1,000 to activate. And also for your information, we are the first broker in Malaysia that actually offer online trading account opening. So basically you can open account from the comfort of your own house. Okay, you don't need to come to our office anymore to open an account if you want to do so. Okay, just a very quick run through about our platform. So we are using the platform called Philip Nova. Basically, it allows our traders to trade both local foreign product. Like I said, we have live chat on the go, even 5 minutes, 1 minute, all sort of indicators for your needs. Okay, this is the desktop version, and also we have the mobile version. So mobile version, we have the application where you can just click and log in the easiest way. Okay, everything is even for live chat is available on the phone also, so you can refer to your chart as you wish. Okay, so we have a demo account. If you want, you can either scan the code to download or refer to our website. You can just go to our website at Philip Futures to download it and to check it out. Okay, now I'll pass it to the speaker tonight to continue with the main topic tonight, which is the grains, which is the soft commodity outlook. Were the bullishness, the super trend, is it going to continue? Okay, so let's welcome David. David is a full-time prop trader with IcebergX Sdn Bhd. Okay, and he is very, very knowledgeable and has done a lot of research in the soft commodities, especially on the grains and the crude palm oil market. Okay, let's welcome David. Yeah, let's welcome David.
Yes, thank you, William. Can you just allow me to share my screen?
Yep, there you go.
Okay. Okay, just before I start, just like to do a quick mic check. William, can you hear me loud and clear?
Yes, I can hear you.
Okay, that's good. Okay, before I start, I'd just like to take this opportunity to thank Philip Futures as well as CME to organize this webinar session, which titled Grains Outlook Will the Rally Last? I believe this is a very interesting time, especially if you are trading the commodity space. I think it is indeed very volatile. And also, just before I begin, I just like to congratulate Philip Futures as well as your recent awards and accolades. Yeah, hopefully that you guys will continue to win more achievements and awards in coming future. So just before I start, very usual disclaimer. I think the presentation today, any materials that is presented is purely for educational purpose. Strictly, there's no recommendation. Do consult with your trading representative for further financial recommendations as they equip and they are licensed to do it. Okay, I think in today's topic, I just want to cover a few areas. I think firstly, if you are trading the commodity space, it's important for us to look at the fundamental dynamics that encompass each of the product. So obviously, we need to look at what are the fundamental drivers for prices. Especially you look at grains, I think corn, soybean, wheat, this particular products has been rallied, at least twice the price compared to last year. Closer to home, we have palm oil, which is hit all-time high last week. So I think across the board, majority of this commodity basket has been rallying to levels that we've not seen in the past. So the big question tonight is, can this rally sustain or can this rally last? I think that's a very important question to address. So I think fundamental perspective will guide us, especially if you're trading in the market. It's important for us to have a bit of understanding of what are the fundamental drivers, and at least when we see sharp rallies in prices or we see sharp drawdown in prices, we know what are the fundamental reasons that actually lead to those drawdowns. And obviously in commodities, one of the key aspects is seasonality. Now, seasonality here refers to periods where you have stronger months, you have periods that is surprisingly doing very well, and also we have periods where prices tend to do a bit less well and weaker on the other side. So I think commodity in general does display a lot of seasonality pattern, and from there we probably can deduce what is the future price direction, and from there we can probably position our trade in a better manner. And I also will cover a bit on soybean oil and palm oil because given that these two are quite interrelated product, and if you are trading on a palm oil space, I think soybean oil is a very important product that you can obviously look into it. There's an opportunity to trade over there. And obviously, as someone that's looking to the market every day and trading the market day in day out, technical trading has been something that is that I use and employ quite substantially. So I'm just going to share with the audience today some of the five key steps that you can use. If you're new to the market, you can start using it, and probably you can navigate your way through the futures market. If you are someone that is already trading the market and you have already existing strategy, perhaps this may be something of an eye opener for you, or perhaps maybe this could be just a discussion topic for you as you're currently trading the market. But all in all, hopefully that this experience does give you a bit of an eye opener and does give you a sense that it's actually a very opportune time for you to be in the market at this moment. Now, just a very brief overview in terms of prices. So 2021, as so far this year has been a very good year, a bountiful year if you are trading the commodity space in particular. Commodities is a very big basket. So if you look at the subcategories, the grains market especially has been doing tremendously well. So obviously you look at the likes of corn, wheat, soybean, those prices has been rallying to record levels. And obviously palm oil is hitting an all-time high. Same goes for iron ore. I think iron ore has almost doubled in price compared to last year. And lumber has been tremendously fantastic product. If you look at the chart itself, it's actually hitting an all-time high as well. So the commodity space has been doing exceptionally well, and I think this spells out a lot of recovery in terms of demand. If you compare last year, we have the onset of pandemic. Prices just slumped to levels, very low levels, but between a short span of 8 to 9 months, we are almost back to pre-COVID levels, and in fact, we are even reaching higher than those levels. So it's indeed a tremendous rally. And if you're someone trading the market, the trend has been always befitting, and definitely there's a lot of opportunity to be made going forward. Now, just to give you a brief context, around the world we have seen a lot of recovery, especially global economy. And obviously last year we have the pandemic. Obviously it was a disastrous year in terms of demand. If you're in the commodity space, first time you see crude oil going into a negative territory in terms of pricing. Obviously 2021 is the beginning year. So this is the year where we probably will see prices going into levels, pre-COVID levels and beyond. So I think 2021 proved to be an exciting year so far for the commodity space. Now this is all mainly driven by a lot of major economies, especially US and China being the major leader and major huge commodity demand. They are mainly driven by these two countries. So their economy, their respective economy has actually regained a lot of footing, and they have recovered tremendously, and therefore it spells a lot of demand, especially for whether it's on energy, whether it's on grains. So I think that what drives the fundamental drivers that drive to such a rally that we're seeing right now. Now, if you look at the current recovery you're seeing, it's indeed tremendous. For the past so many crises we have witnessed, the 2008 financial crisis or even the 2000 dot-com bubble, I think 2020 pandemic, COVID-19 pandemic has proved to be a very resilient crisis in a sense that the recovery is quite speedy. So in all, it took only about 6 to 8 months for the market or for the market to recover to pre-COVID levels. We have not seen that. Past crises will normally take about 8 to 10 months or even up to more than a year. But this COVID-19 pandemic crisis indeed proved to be very resilient. It took only 6 to 8 months for the global economy to start to regain its footing. Now, a lot of factors that actually contribute to this strong recovery. Definitely, it has to spell out central bank intervention. A lot of central banks across the world came into the market and support the economy, whether it's through monetary easing or whether it's through fiscal spending. So all this actually proved to really to support the economy going forward. And indeed, the recovery you're seeing is actually quite fast. Now, if you look at crude oil space, if you're trading a crude oil space, fundamentally, it looks to be quite strong. Demands are coming back. The only thing that's concerned is that the jet demand, which is, as global economy starts to still feeling the surge of the pandemic, but a lot of economies are trying to reopen, so the airline demand is still quite weak at the moment. Unless those demands starts to pick up, I think jet fuel eventually will start to pick up. So crude oil price, what we are seeing right now is considered to be a very fair price. And obviously, as global economy starts to reopen in eventual time, I think prices will also start to increase. So these are a few situations that a few economic situations that we're going to see in the next coming months. Now the key thing is, I mentioned earlier, the central banks actually step in a very aggressive manner. They've been pump priming. They've also give a lot of liquidity into the market through monetary easing. So obviously, interest rate as a mechanism is something to watch out for. If you are someone that is trading on a longer term basis, I think interest rate movement by Fed is very vital and very important to watch out for. So on the chart on the left, you can see that we call it a Fed dot plot. I think this goes to tell you that for the next probably 2 years out, we don't see any chance of increase in general interest rate environment in US. Now, this can subject to change, and I think a lot of market generally is concerned. If watching the news, I think generally the market is very concerned with such a rapid rise in grain prices or even in agricultural prices. It's going to cause inflation, and when inflation is going to be high, I think interest rate is going to be affected. So I think a lot of attention is being paid to this area, and it's worth to pay attention to. We just have to be very sensitive into interest rates, because any hike in interest rates is going to affect treasury yield, and it's going to have a repercussion to your stock markets, and it's definitely going to affect commodities demand in general. So I think this is something to watch out for. But let's see. I think in upcoming Fed meeting, it looks like Fed is maintaining the stance that look, inflation is there, but they are still quite accommodative. I think that's something to tell the market that it's willing to still continue to support the market. But obviously, inflation is something to watch out in the very midterm. Now, back to COVID-19 pandemic. I think a lot of major countries, especially the developed countries, has almost reached a herd immunity, especially UK and US. That eventually the markets are going to start to reopen fully. Now obviously there's development of variant of concerns, and things are starting to slow down a little bit in certain countries. But all in all, I think the immunity drive is going quite well, and eventually the global economy will start to regain its footing. So some analysts are projecting maybe first half of next year we probably could see things back to pre-pandemic levels, but that's yet to be seen. Now, if you are in the commodity space, clearly you look at the world trade has been going very well. One of the ways to track the world trade movement is basically to look into what we call an index called Baltic Dry Index, which measures the shipping rates across the world. Now, if you look at the chart, clearly the rates has been rising from late last year, I think probably around October period. That's where China starts to reopen their economy. So when that happens, you can clearly see that the world trade is actually expanding on a very rapid pace. And every time when you see world trades, shipping rates increase, world trade starts to increase, commodity prices will also start to increase. The reason being because the demand generally has increased. A lot of economies are demanding more agricultural products. So there's a lot of shipments going in and out. Now, shipping rates has been quite bad recently, as in it's actually it's going into 3-year high, 4-year high quite rapidly, given the fact that I think last month you've encountered the Suez Canal crisis. There's a bit of logistical backlog, so I think that's also spelled into higher shipping rates. So this will actually translate into higher shipping costs, and definitely is going to create a lot of bottleneck in certain major ports. So eventually demand is going to be, assuming demand is going to be not growing that fast, but prices will still have to rise, because you just don't have, you're just being faced by this logistical backlog, which could take weeks to ready to clear those backlogs. So I think it's something to be aware of. I think BDI index is showing you that the world is generally growing, demand and trade is growing, so therefore demand for commodities is actually on the rise. Now this comes to another area of concern, which is, I think it's a narrative of the market right now. Everybody has been talking, the talk of the town is, is inflation going to be a concern? Now, there's always two sides of the camp. I think from where Federal Reserve, from their statements if you watch on the news, they clearly states that 2% is their target. And if you look at last few days, the headline CPI numbers was 4.2%. That was a tremendous rise. Assuming, just assume last year, April 2020, the CPI was negative. So 1 year forward, we are looking at a rise of 4%. That's tremendous. So I think that's attributed by higher energy prices and higher grain prices. So obviously inflation is going to start to trickle down, and as a consumer, you will start to feel the impact. So eventually, now the keyword is eventually, Federal Reserve will have to step in. How they will step in is one way is to control the interest rates. So I think this is a matter of time, and I think based on what the Fed comments are, I think generally we try to accommodate as much. But if they start to see the trend is a bit uncontrollable, inflation starts to be a bit more persistent, that's where it's the general concern. So I think, if you are watching the market, you're watching this space, be very mindful what will Fed do in the next couple of Fed meetings, because inflation is going to be a general concern going forward. Now, like I mentioned earlier in my slides, corn, soybean, wheat, soybean oil and palm oil, all these grain prices has actually reached record levels. Just to show you an illustration, if you look at corn prices, April last year, we were only doing about $3 per bushel. Now we are almost touching the high of $7. That's almost 100% increase. Same goes for soybean futures. Last year we were talking about $8. Right now we are talking about $16 per bushel. So generally the commodity price has rallied to record levels. Same goes for soybean oil. Just doing a touch of latest numbers is about 70 cents. Obviously palm oil is both 4,400. Again a record level. So all this goes to show that generally the commodity prices has been reaching record levels thanks to stronger demand, and supply surprisingly has been very, very weak. Not only in the palm oil space, but if you look at in the vegetable oil segments or even in the grain space, they're all generally very weak. So stocks levels in majority of the countries are very low at the moment. So that goes to show price will just have to go one way, which is up. Now, to reiterate my point, 2021 is a year where we see stocks levels, especially for grain commodities, is actually very, very low, record low. And consumption, on the other hand, we have seen rapid rise because whether it's pent-up demand because of the pandemic, but as economy starts to reopen, generally you will see higher demand and higher consumption. So that translates into higher prices across the board. Now, if someone you are tracking on the fundamental side of things, it's very important for us to look at ending stock figures, because ending stock figures would tell you whether the particular commodity is going to be a very more supply situation, or it's going to be a very tight supply situation. So right now we are seeing that stocks levels are almost at 8 years low, and it's actually very worrying because if demands continue to rise and supply just can't keep up with it, prices will just have to adjust upwards. So there's still room for prices to go higher, but eventually I would say market dynamics will come into play. So the big equation here is how is supply is going to play out in the next coming weeks. If weather is good, farmers starts to produce, the yield starts to produce, I think supply eventually will come back into the market, and therefore price will have to adjust. But given the situation right now, we are seeing the ending stocks are actually very low, and that suggests that the prices will just have to remain at this current level for a period of time. Now, I'm just going to start with looking into corn, because I think corn as a commodity has been actually doing very tremendously well. But you look at the fundamentals, it's actually very positive. So look at the slides before, US corn is actually on 8 to 9 year low in terms of stocks level. And obviously US is the second largest producer. In fact, they're always competing with Brazil. Brazil, on the other hand, is also a very major producer of corn, and their numbers are also not looking good in terms of their production. So all this goes to show that fundamental corn is actually very bullish, because we are looking into lower production and lower stocks. So therefore, price would just have to stay at this level. Now, if you're aware, US corn is going into planting season. We are now in a planting season in US. So, farmers there are very enthusiastic because this year, first time they are seeing prices which you are looking into 8 years to 9 years high. So definitely they are looking into very good profits. So the question is whether will the weather be very forgiving? Will the weather be good? So it's crucial whenever US is entering the planting season, prices will tend to be very volatile. So if you are trading the market, it's very mindful for you to watch out on your stop loss levels. Be very mindful because as volatility rises of the market, generally your stop loss will just have to be very tight in case you get stop out. So that's something for us to watch out, especially during this time. So again, I think Brazil and Argentina, the South American supplies for corn doesn't seem to be that promising, and therefore I think that's just why prices is where we are seeing right now. So obviously, if Brazil is not performing and US is going to planting season, if weather is not forgiving, and you're gonna have an adverse weather condition, then prices will just have to find more room for on the upside. But given that, if weather is permitting and supply starts to come into the market, I reckon there'll be some adjustment going forward. Now, weather is an important play. If you are someone that's trading a green space and you're watching the green space, every week we have planting progress given by the USDA. I think those reports are important because as a trader, you need to know or you need to assess what is the market dynamics. Are we entering into a very bullish situation or bearish situation in terms of fundamentals? Now, so what explains the rally from $3 to $7 in corn prices was because of the tight supply. The demand was just too strong. Now as we enter into planting season, which is a critical point, weather is very important. As long as there's no weather extremities or abnormalities like the La Nina or El Nino, it looks like weather is going to be normal. Supply is supposed to come into the market. And with that in mind, I think going forward, the next 2 or 3 weeks is crucial to watch because that's a critical period for planting corn in US. So as those weathers are getting better, it looks like prices will tend to be adjusted in the next coming weeks. So I think do watch out, especially on weekly weather reports and weekly planting progress given by the USDA. So as a trader, you do have to watch out on this fundamental variables as well. So just to highlight, these are the planting season started in US. Soybean as well, you look at it, I think given the current pace, it looks like we are pretty much on track. Hopefully there's no bad weather that's coming to play. And I think as long as we progress along historical average, it looks like we're going to have quite a good supply going into 2021, 2022. So I think that's something to watch out. And if that's the case, I think prices eventually will adjust. So that's on supply fundamentals. Now, if you look into the demand side, so like I mentioned earlier in the slide, we are in a year where supply is tight, demand is strong. Now, if you look at corn, surprisingly, just late last year, China was the biggest buyer of US corn, and those metrics or those quantity is massive. We just look at the bar chart. Year 2020 was a record buying year for China. I think the reason China purchased so much of corn, and in fact also soybean, is a matter of fact they are trying to rebuilding their hog supplies, which is decimated by the African swine flu, which decimated a lot of their hogs. So they need to rebuild those hogs, and as a result, they demand a lot of corn and soybean as a byproduct. So therefore, the price, these two commodity prices took a rally. But the question is, will 2021 be another record year of buying? If you look at the export pace, which again is on a weekly report, USDA does publish those report on a weekly basis, their export sales. It looks like the momentum is still there, but just last 2 weeks, it's actually been slowing down. There's a couple of reasons to it. It's perhaps maybe because the sharp rally we are seeing in grain prices is a bit too steep. And China, being a very sensitive buyer in terms of pricing, so they tend to look out into price as well. So be very mindful and be very watchful in terms of how next few weeks going to play out, especially with export demand, because if you still see strong export and supply is pretty much normal, prices can still stay at where it is, and in fact can go even higher. But if you start to see weaker export sales to China or even to other major destinations, I think that's a point of concern, because right now I think demand is also a crucial variable if you look into the fundamental dynamics. So again, to reiterate my point, I think China last year was aggressively buying, even including the first 3 months of this year as well, right until April. So I say I think China needs a lot of corn and soybean supplies just to rebuild their hog supply in China, which was decimated by the ASF. So it is something that's very important for us to watch out. Can China aggressively be buying more in the next couple of weeks? I think sooner or later the export piece is going to die down because Brazil supply is going to come into the market. It's going to compete with US. So if you are watching US prices, you have to be very careful. So high prices is always a deterrent. You have seen prices rally almost double across the corn and soybean complex. So this is going to be a concern. And I think if you are a buyer of these commodities, when you see prices keep rallying on weekly basis, you'll be very concerned as well because your cost of importing is going to go higher. So eventually there'll be an adjustment. I think the demand is going to soften in coming weeks, and that's why we have to pay a bit more attention to. Now, that's pretty much on supply and demand dynamics. Now, moving on, as someone that's trading this market, it's important for us to assess the fundamental, I would say, pretty much the fundamental sentiment of a particular market. Now, one way to look into it is to look into the CFTC report, which will indicate to you what is the open position of the overall market participants, be it the commercial players or even the retail traders. Now, it's a very good, I would say it's a very good indication. CFTC report, or we call it COT report, Commitment of Traders report, is a very good indication for traders to assess what is the fundamental sentiment of the market is. So whenever you see rising positive net positions in the market, where a lot of, whether it's retail traders, commercial traders, or hedge funds, they are taking long positions in the market and keeping it overnight. I think that tells you that they are they should expect more positive price range in terms of the market price. So that will usually coincide with rallies in prices. Now, whenever you see those positions starts to decline or starts to weaken, the trend of CFTC or COT report, when those positions starts to weaken, that's where you should be concerned of. So just to take example, this was CFTC weekly reports on the corn futures position. I think just last week we have saw the net positive positions start to decrease by, I think, 200,000 or 300,000 contracts. That's a lot, and that's where you see price adjustment. So corn did an almost, I think it hit a limit low on Monday, or even last week, just after the USDA report, and you can clearly it was clearly indicated by lower the smaller net positive position in the COT report. So as a trader, I think we just have to look into this CFTC report as a guidance, as where the overall market sentiment is. So right now it's still net positive. That means generally the market participants are still positive, but they are not that positive as they used to be. So I think this is a point of concern. So we just have to watch out on the next coming weeks. How is the sentiment on the ground? Are we going to see higher positive numbers in terms of COT, or are we going to see slowly declining net positive numbers? So for corn perspective, it looks like the market is trying to factor in a bit of ongoing supply coming to the market, a bit of bearishness in the market. So I think that's generally the concern of the market is right now. Now, if you compare corn, the reason I use corn as a perfect example, and I did a lot of corn analysis here, is because for the first time, I think in many decades, corn prices is almost 1-to-1 parity with wheat prices. Normally in a market convention, corn usually is with a ratio of 2-to-1 to wheat. That means every 2 corn for 1 bushel of wheat. Right now it's almost parity, 1-to-1. And when compared to soybean, there's always a market convention of what we call a corn to soybean ratio. The average is about 2.6 corn to 1 soybean. Right now we are doing about 2.48, which is way below the average. Now what this goes to tell you is that one of the particular commodity is moving, the price is moving quite rapidly, while the other one is still lagging behind. So if you believe in a mean reversion, which eventually the market is going to mean revert, we're probably going to see some adjustment in corn, and you're also probably going to see some adjustment in soybean. So technically, from what we are seeing right now, the corn is priced less competitively compared to soybean, and eventually as a farmer, there's a lot of incentive for you to plant corn, and eventually those supplies will come into the market and you'll bring down those prices. So if you look at the corn to soybean ratio, so right now we are doing about 2.48. If you on average it's about 2.6. So eventually the ratio will adjust back to 2.48. No, sorry, 2.6, but it will take time. So I think that's what, as a trader, is very good for us to look at ratio in terms of prices, because that's where it used to indicate which particular commodity is overpriced and which particular commodity is underpriced. Now, this is a bit complex, but do bear with me. If you are someone that's trading spread, I believe you understand this notion of backwardation and contango market, the market structure of a futures contract. Now, if you're someone new, I think spread is basically looking into two particular, whether it's the same product, different months, or whether it's a different product but it's interrelated. So right here, what we have is the same product but it's a different month. We call it a calendar spread. Now, when you are trading the commodity spread, grains market, and when you look into a spread, we always compare what we always term it as the old crop against the new crop. Now, in soybean, the new crop is always referring to the futures contract month of November, and corn is always referring to the futures contract of December. So any month that's not in the December contract is considered as old crop. So there's always a ratio that the trader likes to use, which always comparing the new crop, the old crop against the new crop. Now, if you have traded the spread market, it is very interesting in the sense that, spread market usually is in harmony, which means that there's a natural average. Say, for example, if you are in a backwardation market, which means further prices is lower than current prices, generally the spread is very positive. And if you take the old crop and compare with the new crop, there's normally what we call an average spread value. That normally be 12 cents or 16 cents. So in this example, I'm actually using corn, comparing the July corn with the December. So you can clearly see that the spread actually starts to widen early part of last month, and actually widened to as high as 52 cents. So I mean, that's generally tells you that the market is generally, when it's in a big rally, the spread can tear. So if you are trading spread, it's very important for you to understand fundamental dynamics as well, because it does have a big impact. And when spread breaks away from its natural range or average range, that's where you see big rally. So if you are a spread trader, you want to find opportunity like this, it's important for you to look into this type of pairs, especially when you start to see fundamentals start to shift. Normally you start to see when you break out the particular range, it's going to be very aggressive move. So it's a way to capitalize on such a move. Now, so that's on corn. Soybean is a very similar picture in terms of fundamental perspective. Again, we are seeing strong demand, and again, the supply is also very weak. So I think for soybean fundamentals, I think the demand is a bigger picture. The demand was a major driver in terms of prices. So you look at China, again, they are the biggest buyer for soybean as well. The major reason is also again to rebuild their hogs, and obviously I think there's also a bit of restocking because during the onset pandemic, they literally closed their borders. They didn't import much of soybean, so only towards the second half of last year, that's where they start aggressively buying and restocking their stocks again, because when they start to reopen their economy, there's a lot of pent-up demand. So that explains why China continued to demand a lot of soybean. Now, if you look at CFTC report, again, I think soybean is still on a net positive territory, which indicates that a lot of market participants are expecting a bullish scenario in the soybean to persist. But like I said, do pay attention to the change in the net positions, because these reports are published on a weekly basis. Whenever you start to see net position starts to decline, especially on a very strong uptrend rally in prices, that's where you have to be careful. Generally, those sentiments are trying to tell you that despite the price rally, a lot of market participants are generally covering their positions or in fact turning bearish. So I think that's something for us to watch out. And I think CFTC and COT report is actually a perfect report and perfect indication for you to be added as part of your analysis tool whenever you trade the greens market. Now, vegetable oil. I think soybean oil has been also another major star performer this year. If you're trading on a palm oil, obviously soybean oil is a perfect byproduct. Both prices are moving in line. Now, soybean oil has seen a major rally. It's also partly because of soybean, but there's also another reason to it. If you look into President Biden's policy, the green energy policy does says that US is going to go into a very aggressive mode of converting some of their energy demand into biofuel. So that's very positive for generally for the vegetable oil market, whether it's on the ethanol or whether it's on blending your vegetable oil with diesel, which is your biofuel. I think this generally spells positive for the market. So soybean oil rarely in that perspective, and obviously that also translate and that also put a bit of positive effect into the palm oil space as well. Now, if you look at fundamentals of soybean oil, this year again you're seeing lower stocks and stronger demand, being backed by stronger soybean prices, and also China also demanding a lot of vegetable oil, and also partly contributed by Biden's energy policy, which requires a lot of biofuel. So I think that's actually contributing to the overall strong performance in the soybeans oil space. Now, going through the grain crop calendar, I think if someone who generally trades the market in this particular grains market, it's very important for us to know the seasonality, because if you realize when are the planting seasons and harvesting seasons are, then you generally will know where prices will tend to go. Like I mentioned earlier, right now we are going into the corn planting and soybean planting seasons. So weather is an important play. So watch out. I think price is going to be very volatile. If weather is going to be very volatile, same goes for prices as well. Only when it comes to September, October, that's where it's the harvesting season. It's also another important period because as long as if they don't harvest sufficient supply, prices will have to adjust, and vice versa. So I think this is important for us. If we trade this particular commodity, is vital for us to understand when are the period of planting and when are the periods of harvesting. Now, I just mentioned earlier in the webinar agenda is to talk about seasonality. Now, seasonality is important if you trade commodities because there's always a pattern that you can recognize. Same goes for CPO if you're trading palm oil as well. Now, if you look at corn in general for the past 20 years, if you look at the average performance on monthly basis, June, July, August is what we call the period of weak periods in the commodity space. Why? Because these are the periods where generally the planting has been done, they will start the harvesting, there's supply coming to the market, and generally when you have higher supply, lower demand, you're going to have price adjustment. Now, surprisingly is that the first half of the year, usually January, February, March, or even April, we tend to see strong prices. And surprisingly for corn, the month of April itself, it recorded almost 20% increase in terms of price. I think so far that's second highest on record for the past 20 years. But it goes to show that when commodities rally, it's going to be a very aggressive move. So going forward, if you look at seasonality pattern, June, July, August is where the period you should be careful for the corn market, because that's where you're going to go into harvesting season, and normally those periods are the weaker demand periods. So you just have to be very careful when we enter into those periods for corn. Now, soybean is a very similar picture because the harvesting and planting cycle for soybean is very similar to the corn cycle. Again, you look at July, August, September is where the periods where we start to see negative prices. Now, it's important for us to take note. Those average to take note on the average change, a monthly change in terms of price. So July, you look at the month of July, on average, the past 20 years, you probably will look at about 3 to 4% decrease in terms of price. This is based on 20 years data. So again, these are all historical perspective, because generally there's a cycle in commodities. Now, what can change the cycle is always the fundamentals, be it the weather, be it change in supply, change of demand. This can alter the historical pattern. It can serve as a guide, because now we are going to enter the crucial period where these are the weaker periods and months for this particular commodity. So it's important for us to watch out. as we enter into the planting cycle and also go into the harvesting cycle in coming into August and September period. Now, just to share with you a market structure, because like I said, I think it's very interesting times we are in, especially trading the commodity space. A lot of asset classes right now are showing what we call futures term backwardation market. Now, what is a backwardation market? Backwardation market is simply says that, you know, futures contract, we have many contracts on the market listed, and those further month contracts are actually, the prices are lower compared to your current period, or what we call spot contract months. This is very unusual because this only happens when the market is extremely bullish, you know, and I like to reiterate is the word extremely bullish. Now, when you have a very steep backwardation, you can see from the chart here, the line here, the front months are very steep, which means that you look at the difference between May contract and July contract, you're talking about, you know, $2 to $3 difference, which is very steep. You don't see that kind of spread for at least for many years. So this goes to indicate that the current market is very tight. Eventually, the market will adjust. But what is important to take note here to look at the market structure of this forward curve is because generally the market will always perceive as we go into as we hit into longer periods, the market is still pretty much neutral or positive, which indicates that prices will tend to go back into neutral probably between second half of this year or early part of next year. That's why you see prices of corn, you look at the December contract next year is doing about $5, which is quite fair, you know, if you look at the neutral perspective. So what it goes to tell you, the current situation you are witnessing now could be a temporary situation. The tightness could be temporary. So it's important for us to take note, and important to watch out the change in the curve. If the curve starts to get less steeper, that's why we have to be careful. That means the price will tend to adjust as well. Now, same goes for soybean. It's also a very steep front curve, which indicates that the market is very tight. But if you look at the farm prices, you look at December or even July 2022 next year, now prices should be about $12 in terms of soybean prices. Right now, it's doing about $16. No, that goes to show eventually the market believe that the market will go into neutral gear again. So that's something for us to take note. Now, if you are someone who's trading spread again, we are in a very steep backwardation market, so your spreads are generally, being aggressively pushed. If you're looking into the front month spread against the farm month prices, the front month spreads are crazy. You're looking into again $3 to $4 difference, which is unseen of for many period of years. So I think we are in a very interesting time. It goes to show you are trading spreads. Definitely there's opportunity there. But you just have to be very careful, because once the market starts to adjust back, once the equilibrium is trying to rebalance the equilibrium, spreads will tend to collapse after a massive rally. So that's something to watch out. Now, I like this chart because if you are trading palm oil, soybean oil is definitely a must product to look at, because there's a lot of interrelationship between these two products. And there's always a market common notation between what we call the soybean oil to palm oil spread. There's a spread between these two products. And if you look at on average, the spread is about $100. Anything more than that, the market will self-adjust. Now, obviously, there's last year we've seen the extreme of this spread. I think just late last year we saw soybean prices to palm oil prices were almost close to parity. That means if I'm an importer and I can import soybean oil and palm oil, I would definitely import a lot of soybean oil because it's much cheaper whenever the spread goes to zero. But that situation didn't last long. In fact, it readjusts and it closed above. It went above the parity. Now, periods of parity is not very common, and if it does happen, it only lasts a very short time. Now we are faced with another extreme scenario whereby the spread is doing almost a multi-years high. I think right now it's doing about $370 to almost close to $400 premium spread soybean oil to palm oil. Now that's very interesting. So that goes to show soybean oil is literally very expensive compared to palm oil. If you believe in mean reverting, which means that the average will tend to come back to its original fair value of 100 US dollars, there's a few things that can happen. First is you probably will see adjustment in soybean oil prices. Probably will see lower soybean oil prices, and palm oil might adjust on the upside because if you compare the competitiveness, I think palm oil is still very competitive, despite we are seeing all-time high prices. So I think this spread dynamics, you are trading the palm oil space, do watch out. In fact, you can use this as a guidance on trading your palm oil to even the soybean oil spread, if you intend to. So I think it does give you a picture on how the spread dynamics is, and where both the markets are right now. Okay, so going to the last bit of my presentation, I think it's important for me to also just to highlight how do I set up my trading setups in order for me to enter the particular market. Now, I think first step is always to identify the trend. As a trader, you always want to identify the trend because especially now we are in a very trendy market. We are not in a range market, we are in a big trend market. In fact, a lot of the common catchphrase will be we are in a super cycle. So obviously we are in a very massive trend, and the best thing as a trader is to always be in the trend on the market. Be on the trend on the market. Don't fight against the trend. That's what the common notation is. So I think first thing is always identifying the trend. The trend is clearly clearly on the upside. So one of the ways is to look into 200 EMA. So as long as prices are trading above the 200 EMA, that goes to show that in fact we are in a long-term rally. So both the US soybeans and US corn, both of these markets are in the long-term rally. So the first thing you do is to use the 200 EMA as a guidance for you to identify the trend. Look at where the candles are. Is it above the line or is it below the line? Now, we can also use it as a crossovers. Whenever you see that candles are touching the line and cross, whether it's above or below, that's usually a signal. 200 EMA line is actually very powerful because you're talking about almost a year worth of trading data. Or in fact more than 6 months. So I think that's telling you that the medium to longer term trend has probably changed if whenever there's a cross below or above this line. Now, another way to identify trend is, besides using the 200 EMA, is also to look into what we call what I like to use besides the candlesticks is to look into another derivation of the candlesticks, which is Heiken Ashi. Now, Heiken Ashi is a derived from the candlesticks, but it's slightly different in a way that it's always taking the middle of, or rather the average bar of your candlestick bar. Now, why I like to use Heiken Ashi is because for a layman, if your layman eyes, it's very easy and very distinct if you want to see the trend. For example, if you look at comparing the candlesticks chart and compared to a Heiken Ashi chart, you can clearly see the green bars and red bars clearly. Now, Heiken Ashi, whenever you see big bars, normally it signals to you the trend is going to be very big. If you're going to see short bars, usually the market is quite indecisive, like a doji in your candlesticks. So pay attention to, if you use a Heiken Ashi principle, look into the bigger bars, because the bigger bars are telling you that the trend is going to be strong. Shorter bars are always telling you that the market is going to consolidate or going into sideways market. So that's also where you can take it as a turn of signal. Now, so once you identify the trend, definitely you need certain setups for you to identify what are your crossovers, whether to signal you an entry position or to signal you an exit position. One of the ways, besides using Heiken Ashi, I also incorporate the moving averages, which here again are using exponential. Exponential or EMA is a bit more reactive compared to simple moving average. So in a sense that it's actually cover most of the candlesticks or quite rapidly, quite instant. So in my parameters, I use a 9 and 20 days. So that gives you about 2 weeks and a month worth of trading data. So it goes to show how the market has evolved in the past 2 weeks and the past months. Again, you can work on the crossovers. Whenever you have the shorter time frame EMA crossing above the longer term time frame, that means the market is going to go into the bullish phase, and vice versa. So you can use some moving average crossovers accompanied by Heiken Ashi candles. So for example, you look at the one I highlighted here on the left. You have the EMA 9 crossing above the EMA 20 line, which is the shorter time frame crossing above the longer term time frame, and the Heiken Ashi candles from a consolidation phase going into a very big green bars. So when you see that, that means the trend is starting, and normally that's the entry you take. When you get out, there's two ways. Whenever you see a candlestick break below that particular moving average, that could be your exit point, or you could even take the crossovers in your moving average. It means that whenever your shorter terms are crossing from above, that's where usually it spells the end of the trend. So crossovers and Heiken Ashi are two fundamentals way for myself in terms of technical perspective to go into the market and or even to exit the market. So here another example. So once you see crossovers and you have to accompany by the Heiken Ashi bars, if the Heiken Ashi bars are telling you there's a trend, you have to be in the market. But once Heiken Ashi is turning into indecisive, that's where you should be coming out of the market. Again, it all depends whether you're a trend trader or you could be a sideways trader. For myself, I'm more akin to a trend trader because the market generally is very trending now. So there's more incentive for me to follow the trend. So covering the last bit of the trading strategy is always you must have a risk management in place. I never believe in taking a trade without a proper risk management because that's pretty much you are just risking too much, and over the longer term you probably will suffer quite a bit. So risk management is very vital. If you are new to the industry, if you are new to trading, it's definitely a must. So one of the ways for me to establish risk management is to use what we call the ATR ratios, the average true range ratios, which measures the particular range of the particular market. Now, notice that ATR value has been rising across major commodity asset classes. Reason being is because you look at the volatility per day, it's actually increased tremendously. So as a trader who loves volatility, I think it's definitely a good time. But keep in mind, you just have to make sure that you put the stop loss with sufficient amount of buffer, because if you put too tight of a stop loss, you get out very quickly. If you put too big, you are risking too much. So use ATR as a basis for you to place a stop loss. So say goes for this example, the US corn, the daily ATR value for the 14 days is about 15 cents. So every time you enter into the corn market, make sure you have 15 cents as a stop loss level from whatever entry price you enter. And if you work on a risk to reward ratio 2:1, so you make sure that you're rewarding yourself with at least 30 cents, then only your trade is profitable. So ATR will serve you as a guide. So whenever you see increased volatility, you definitely have to make sure you have enough buffer for your stop loss level as well. Don't set it too tight, because set it too tight, you get a lot of whipsaws. So ATR is a very good risk management tool, and you should incorporate into every trading management that you intend to take. Now, just to illustrate to you the movement, I think soybean has been actually very interesting. Same goes for corn. So just late last year we were doing about $8. Right now you're almost touching to $17, which is tremendous move. Now this particular move is steep, and if you compare to 2007 move, is also steep. But do take note that you look at 2007 before the global financial crisis. The downside bars was actually quite limited, but the thing is that the rally was also very sharp. The downside was also very sharp. This time now we see only a one-way sharp rally. They're bound to have adjustment, but I think the adjustment is going to be very short adjustment. Eventually, the market is still going to trend up. Now, I think important question for us to take note after explaining, after sharing on the fundamentals as well as some of the key variables that you need to watch out for. I think generally the trend is still on an uptrend, but eventually you just have to look into critical support and resistance levels, because generally markets are very sensitive to those levels. And if it does break those levels, market is going to go higher. Whether are we going to revisit the 2011-2012 high at about 1750? That's a possibility, as long as China continue to be buying in the market and supply still going to be very tight. I think there's possibility of going into above the $17 mark. But if supply and coming to on-stream demand is going to be weakened in coming weeks, it's going to be a concern whether are we going to see those levels, which I don't think so if fundamentals starts to shift. Now, just to show a bit of technical levels, I think corn itself, 8 levels is pretty much in play. But I think just after the USDA report, even though they show that it's going to be a lower supply of corn, lower stocks level, but market take it as, you know, it's pretty much adjusted, and therefore actually plunged to 3 to 4% on that day itself. So I think corn is still very sensitive at the moment. It's sensitive to the fundamentals variable that's developing. So going forward, I still see corn is still supporting around this level. I think going below $6 is critical mark, because that shows that, you know, this corn itself is on a weak sentiment. But if it does hold above $6, I think $7 is going to probably revisit, and probably could revisit the $8 again. So again, I think, you know, corn, soybean is reaching multi-year high, and ultimately it's going to translate into inflationary costs, whether it's for the producer point of view or whether it's a consumer point of view. So inflation is always a sign of concern, and again, you know, you have to watch that space very carefully, because it's going to affect many asset classes going forward, because that's going to put your Federal Reserve into a very tight corner. Whether are they going to increase interest rates or they are not going to increase interest rates. Okay, so this on soybean technical. Again, I think the $16, $17.50 is the all-time high. I think it will reach the $17 again. But the question to revisit the all-time high, it have to depends on the fundamental point. Whether are we going to see supply and demand dynamics a bit more equilibrium? I think that's an important question for us to look at. So all in all, I think the commodity space, especially on the grains market, is still continuing on an uptrend. And if you are trading the space, you should be finding positions to be aligned with the trend. It's always a difficult business to always time the reversal of the market, because it's just too much of a risk. You never know when the market will turn. But you know, eventually the market will readjust. There'll be a retracement. But as a trader, you wait till those signals or wait till those patterns starts to form. There's no point of timing when the reversal of the market is, because you know, eventually the market will just have to break a lot of key critical levels and you will hit even higher. So I think corn perspective, I think $7 is here to come. Soybean is probably going to see the $16.80 or even $17. Now, if you look at soybean oil, the 70 cents mark is easy to reach. I think the highest all-time high is about 72. It's possible because you look at palm oil, it's already all-time high. So I think, you know, grain as a whole, the trend is still there. I think eventually give it a next couple of weeks are crucial, because if fundamentals doesn't gel, you should see a bit of retracement in all these commodity, all these green commodity classes. Okay, so with that, I'm just gonna end here. If you are someone new to the trading journey, I think it's a very good time for you to be in this business. Now, just to quote you a quote from a very famous trader went up, you know, if you come with the attitude in this business, you have to come with the attitude of owning that business as your own. Generally, you need that kind of mental attitude, because generally, if you don't have that kind of mental attitude, when you have even a very volatile market, you know, it really will challenge you to probably a brink of point, and that's where it can be very challenging and very strenuous. So if you're someone new, you want to consider this as a journey, you know, treat it as part of your business. I think it's going to be very rewarding at the end of the day, you know, if you get it right. So with that, I'm just going to hand it over to William, who's probably we do have some time for Q&A. So William, over to you.
Okay, thank you, David. Thank you, David. Okay, now let's. Okay. Okay. Now, okay. Let's start our Q&A. But before we move on to the Q&A, just a very quick one, just to let all of you know about the promotion that we are running right now. So at the moment, we are doing a TGIF promotion where every 15 lots that you trade, we will rebate 100 ringgit back to you. Okay. So if you are interested to find out, you may contact us lah. Okay. So at the meantime, you can type all your questions and I will ask David just in a second. So for those that wants to open an online trading account, you can do it online just by scanning the QR code here. Okay, you can do it on your own, and someone will contact you the soonest possible. Okay, now let's move on to Q&A section. So anybody have any questions regarding tonight's webinar or on the movement of soybean, corn? You may ask it away. Yep, okay, let me see. Okay, so before, actually I have a questions myself before we wait for people to ask. Okay, just a question from myself that I observed recently. I believe that actually a lot of the attendees tonight, I think they are not just monitoring the CPO market, not just monitoring the soybean oil or corn market. We are also all monitoring the CPO market. So something that I personally see today on the CPO market at the last minute, I think that there is something very aggressive, some very aggressive buying power at the last hour on CPO market. Do you really think that based on the current month-end inventory on CPO, do you think that the current price is sustainable?
Okay, thanks, William, for that question. I know the audience here are more, generally we have more familiarity with CPO. Now, CPO is very interesting in the sense that, we are entering into a very high seasonal production period, but we are just not seeing those numbers. That's a funny thing. Secondly is we are also seeing exports to be very strong. Now, today we have seen prices in BMD market, CPO, rallying about close to 200 points. There's two reasons. One is mainly because exports are up by 22%. I think a lot of market expectations are expecting that probably stocks may be unchanged or maybe even lower. The key thing is lower. I've seen market CPO for many years. Stock levels like this, we thought you're going to be very fast, but to clear about this, it's not the case. So, if we're going to see lower stocks, strong demand, I think prices will just have to be one way up.
Okay, so in short, the buying power today, for those that are monitoring the CPO market, so I think the buying power at the last hour of the trading hour on CPO is most likely is going to reflect a very low inventory level, like what you share on corn and also on soybean, all this while even lower inventory level that all of us can imagine, probably, I guess so. Okay.
Yes.
Yeah. Okay. By the way, anybody with any questions with soybean and corn? If no, then probably I will just ask one last questions. Then we will end these webinars. So maybe these questions is about soy oil. Like what you shared earlier, that soy oil currently, the premium that soy oil is trading above CPO is like over $300 US. The premium, that is the premium of the soy oil versus the CPO. And based on the average, like what you mentioned, it's about 100 to 150. So with this kind of almost 1 times higher of this kind of premium, 1 times higher premium on soy oil versus the CPO, does that mean that CPO is going to go up even higher to match the soy oil prices?
Okay, that's also a very good question. If you look at the overall spread between the soybean oil and palm oil spread dynamics, we are clearly on a very overbought situation in soybean oil space. Now, from past experience, the way I look at it, soybean oil will tend to have massive adjustment. Palm oil could stay at the current level, but again, I think what it goes to show is that the adjustment is more, there's tendency more towards the soybean oil rather than the palm oil. So I wouldn't say there's more room for palm oil to go up, but there's a lot of reasons why palm oil can still go up. Because if you look at it, soybean oil is relatively much more expensive. Palm oil is still very cheap. It makes more sense for importers to really look into palm oil and import on that perspective if you compare to soybean oil. In fact, in other vegetable oil as well. So I think with $370 as a premium, it is very heavy.
Okay. So based on your opinion, is most likely what we will see in the market is for soy oil to adjust downward to match the CPO.
That's the likely scenario based on historical pattern from what I observe.
Okay. Instead of CPO shooting up to match the soy oil. Huh?
Yes.
Okay. Just one last question that someone asked: what is the best trading time for US brands product? Do you reckon for traders to participate? The best trading hours for brands?
Okay. Depends on which product you're looking at. For soybean oil, on Malaysia timing, after 9:30 is the best time. After the mid break, 9:30 to 11 p.m. That's the best time. Soybean oil during Asian hours is not that aggressive compared to palm oil. So if you really want to look into soybean oil, the best time is to look into the night market after the mid break, 9:30, probably to 10:30 or to 11. Then again, before the market closes, probably around 2 a.m. That's where you can see sharp movements. Because you need that volatility. Sometimes soybean oil could be quite stagnant for 1 to 2 hours. That's very time consuming. So I would say for soybean oil, it's roughly after that. Corn and soybean, again, is also around the 10 p.m. mark. Normally, they are very active when during the US hours, not on the Asian hours. Asian hours, because there's no news. So I would say, if you want to trade these products, those are the active hours are mainly the US hours.
Okay, so generally all the CME products, I think the best trading hours is when US people wake up, which is about 9:30 of our time, Malaysia time 9:30, which is where US market starts to get very active when people start waking up and start trading. Okay. Just one last question, because I think questions start popping in right now. One last. Okay. So with such high prices of corn and soybean, do you think the demand will still keep going up, and eventually will people start to cut production due to these high prices? Yeah.
Okay. That's also another very good question. Obviously, the current high price is definitely going to affect buying. China has I think, I mean, okay, one of the reasons that I mentioned earlier was because of the African swine flu. They want to replenish their hog, they buy a lot. But another reason is they're also restocking. So what I see is that once China has achieved sufficient level of supply or stocks, I don't think they'll demand it. And that's the dangerous point. Because right now the market is really rallying on very strong exports to China. And when those exports starts to decline or not coming in at all, and I think that's a concern. So eventually, I think high prices right now is slowly starting to make China feel the pinch. And eventually they just have to adjust. In fact, I think there's a couple of days ago, there's a news saying that China may replace corn from US with another particular product. It could be wheat, or it could be other product that is actually much cheaper than corn. That's why you see corn starting to adjust a little bit as well. So obviously, current high prices is definitely going to affect demand from China. So it's a matter of time. That's important. But what I see is that the supply is still tight. Stocks levels are still very low. So that's something positive. But when those things start to change, I think that's where you should be careful.
Yeah. Okay. Thank you. Thank you, David. I guess that is all for the Q&As tonight. All right. Okay. And thank you everyone for joining our webinars tonight. If you have more questions, you can probably just email in and we will get David to answer it. And also lastly, before we end the session, just want to say a very big thank you to CME for collaborating with us tonight to invite David to share with us about the grains market. And for those that wants to follow us to get the latest news, you can follow us on our Facebook, on our Telegram, or YouTube. We always upload all our webinars onto our YouTube, so do follow our YouTube for all the previous or the past seminars for the information. All right. Okay. Thank you very much, everyone, and yeah, have a good night. Bye bye.
Okay. Thank you. Take care.
Thank you. Thank you.